Good morning, everybody. Welcome back. We're joined by Tony Greer of TG Macro. Tony's been coming on talking about the macro markets and equity plays. Welcome, Tony. How's it going?
Good, Mike. How you doing, man?
Good, good. Back from the weekend, and got some interesting stories out there. I know that you've been talking about recently social media underperforming, and right now we start the day and Nasdaq's weaker, and social media is underperforming, led by Twitter's down about 4% today.
Yeah, we got a little bit of a bounce, which I said that I was hoping for last week to, initiate a short position. I've been trying to short it between 32 and 34. So the social media ETF just peaked its head up above 32 there. As I've been mentioning, IAC Interactive has been the juggernaut stock in that sector, which has just been running up and to the right. It's finally backed off the highs. And now we've got the biggest name in that sector, Twitter, breaking down through the neckline as promised, through the neckline at $30, and sort of dangling to a new low for the move here at 28.85. Like I said, I still think that goes much closer to 25, possibly below it. I feel like they've seen their absolute best day in the last couple of months, with the stock up at $45 consolidating. And then we saw Jack Dorsey get in front of Congress and kind of blow everything to bits. So I'm still bearish Twitter, still bearish the social media space. I'm going to keep a close eye on that. And we got to watch rates, right?
Yeah, absolutely. And just getting back to Twitter, we traded up to almost $50, 47.50 a few weeks ago, and here we are cut in half. We're at nearly 28 right now, 28.75.
Yep.
So that's really trading poorly.
Users leaving the platform where they are shadow banning conservatives. I think it's pretty basic.
Yeah. Then, we wanted to talk about yields. We've had a fair amount of data last week, and we're right now at 301 right now in the 10-year, so been grinding higher. What are your thoughts?
Well, we saw ripping data last week, right? We saw really solid data, and this is why I don't want to sit here and wait for the U.S. economy to curl over magically, because it seems like it's pretty strong. We've got consumer confidence is literally, carving a new high with each print, whether it's Michigan consumer confidence or if it's the NFIB small business confidence. This is what is basically, the consumer feeling pretty strong from the economy beneath their feet, and when you get that kind of feeling, you get the money out of your wallet and you spend it on whatever you feel like. And, that's what it feels like the economy is sitting through right now, and that's why 10-year yields are peaking their way back up above 3%. I have a feeling that this may be a little bit more longer lasting than people are expecting. Everybody's looking at the big net short position in the Treasury futures market. And it still looks like one of those trades where all of the people positioned for it just might be correct for another time to come, because the US data has just been fierce. So I'm going to look for US yields to bounce even further upward towards the 310, 320 range. We'll see what happens from there.
What do you think if we were to start to get, if this trade rhetoric picks up between China and the US, which has caused volatility in the past, do you think that if we were to see, equities trade heavy possibly on that, would that be a downward, would that affect rates?
I don't think so anymore, Mike. We've had about 5 consecutive dips that you can see right as clear as day on the chart based on trade wars, right? The first one was to 2,600. The second dip was to 2,700. The third dip was to 2,800. And here we are at 2,900, right? So there are trade wars going on, I suppose. But when your team is winning them once again, you don't have to worry about them jolting our stock market. We're clearly seeing the stronger dollar pressure manifest itself in emerging markets. And, I think it's China that should be concerned about, another US headline jarring their market lower, because that's really how we're positioned right now.
Well,
You know,
they have, you take a look at Shanghai indexes at the lowest levels back to 2014. Take a look where we were, much different picture.
Yeah. I mean, this is the president leveling the playing field, and the United States is no longer going to be the global piggy bank for all of the weaker countries out there. And this is what you see going on before your eyes every day: is the market naturally adjusting to it. And really, it's just a lesson of capital is going where it's treated best, and it feels like a lot of capital is being treated best, in the U.S. stock market right now. So that's why I think the dollar strength continues. I think that the more Trump seems to ratchet pressure on the trade tariffs, the shallower the stock market dips. So eventually there's going to be a headline where he comes out with a sort of softer tariff than expected, and the stock market's just going to roar because it's going to seem like that it's been held back by this trade tariff conversation. So it's tough for me to get bearish when the market shakes off everything that that has sort of line of thinking has thrown on it. To me, it just looks like a massive, massive aggressive rotation. You've got transportation stocks, healthcare stocks, and aerospace and defense breaking out. You've got this adjustment here where tech is pulling back, led by social media. You've even got semiconductors pulling back just a little bit in their consolidation range. So, I'm still looking for a sort of violent rotation with a little bit more, upside bias. That's really all the market is right now to me.
Yeah. Now, what about, you mentioned before yields, and you like yields higher, and you also like the dollar higher, which typically often do trade in tandem. But today we're seeing yields higher, and the euro and pound, the dollar's weaker by about 0.5%. Do you get the sense that if we were to move higher in yields, that it would be dollar would go with it?
I think this is just a light period of we're seeing a little period of cable strength here, right? They're talking about some smooth scenarios to get through the Brexit. So, you got the pound rallying from 126 back up above 130. That's obviously a weak dollar dynamic. So I'm not shocked. But what I feel like we've been seeing is a continuation of the G7 sort of just kind of, slightly rearrange itself while emerging markets continue to get knocked down a peg. So, while emerging markets have stopped descending, it would make sense to me for the dollar to sort of back off. But I'm really not getting concerned about it, Mike. It feels like these are just adjustments toward the G7. And I think that, broadly speaking, the dollar is not going to get knocked down too far. I really don't.
Yeah. And another thing, we wanted to talk about was the home builders. We see yields moving higher. Lumber prices have been moving lower, which is typically correlated with home builders. What are your thoughts on the home builders?
Yeah, Mike, I've been bearish. It's been one of the short positions that I have been running because it hasn't been hurting me. At the same time, it has been a long run. I've been short since the beginning of the year. I guess around February or March, I started putting out XHB as it was breaking down through the 200-day moving average at 42. And now we're really, we've been bottoming. It's been trading between 39 and 41 for the last 6 months.
Yeah, I have that chart up, not doing a whole lot, but not bullish.
No, it's one of those things where, you definitely want to stay disciplined and get out of your short above the market where you say, and my stop's above 42, so I'll be out if it trades up there. At the same time, the story remains the same in terms of my position towards builders, right? We've had the negativity in the building sector has been in the economic data. Existing home sales are weak, inventories are building, and that data hasn't impressed anybody. So the actual home builders can't get up and running. The price of lumber has come dramatically off the highs, and the builders themselves didn't see any benefit whatsoever. I'm talking about Lennar, Toll Brothers, D.R. Horton. They've been sideways as the price of lumber has come off, which is beneficial to them. So that's really not a good reaction by the builders. And now that we've got, the long end yields haven't been rising commensurately with the short end, obviously, because we've got the story about the yield curve really, really coming apart. But the 30-year yields are back towards the highs of their range, which is going to put 30-year mortgages back towards the higher of their range. So now you've got a high cost of capital, and these problems are sort of reemerging. So I can stay bullish home builders as long as price continues to agree or sort of not stop me out on the upside, I should say.
Now, what about people that are highly correlated with home builders, like let's say people that supply the home builders like Home Depot, Lowe's, things like that?
Yeah, well, those are members of the ETF, so they're definitely relevant. Those are a major part of the construction industry nowadays. Home Depot has been a difficult stock to fade, and it has gone back to being a difficult stock to fade. It had a little bit of a consolidation in June, July, and August, and then just broke to a new high above 200. I don't like to fade Home Depot because I got to go to the store twice a month as a homeowner just to keep things in line around here, and there's always a line. So Home Depot is a tough fade. Lowe's is another tough fade. Lowe's trading literally a 52-week high as we speak. And then another factor inside the home builder ETF is Williams Sonoma, which is another great store to me, not really as much as a home builder type of store, but a kitchen and cooking supply store that I absolutely love. So I'm sort of fading a couple of the names that I don't like here because I think that the weight is actually going to be in the home builders numbers. And I think this weak economic data in the housing sector is eventually going to translate through to the actual builders numbers. And that's why I'm going to stay short the XHB for now. I think if I was smart and a little bit more diligent about this trade, Mike, I would figure out which are the two home builders that I really like the least and just be short those and then get out of the ETF because this, Williams Sonoma and Home Depot are hurting me.
Yeah. I'm looking at the chart of Williams Sonoma here. What's gone on in the past summertime, basically? It looks like they've popped from the low, mid 40s to at one point up to almost 75. That's a huge move for a stock like that. What was the data or news?
You haven't heard about the new crockpot phase that's going on?
Is that enough to move the stock about 100%?
Massive phase in the U.S. where dinner parties, people are having more crockpot dinner parties than ever before, and I think everyone's running out. No, I just made that up, Mike. I haven't seen what's going on in Williams Sonoma because it's just a portion of the ETF. I'm sure we can look up and see if they beat numbers. I would imagine that it's something like that.
Yeah, I wasn't sure on the story. Because that's a pretty significant move. It was hovering for over a year and a half, basically between 45 and 55, and then really broke out, consolidated, then another breakout.
It looks like they beat estimates. It looks like Morgan Stanley raised their price target after their last earnings report, and they beat Q2 earnings. And I would imagine that as long as they continue to do that, the stock is going to continue to perform like it has. That's one of the tough battles that you're fighting if you're short XHB as an ETF when you're really, like I've made clear, my idea is really to be short the builders. And now I've got a couple stocks in the ETF hurting me. So I got to consider it.
Yeah. No, and last week you mentioned you are bearish the metals, social media, and today you're adding home builders, which you've been bearish for a while, but just talking about home builders versus bullish some healthcare, transportation, things like that.
Yeah, transports still look good. Transports still look good to me. I feel like a broken record here, but with this kind of a GDP and inflationary and tight freight scenario, the rail companies are going to just keep trading up and to the right. As long as the economy is in okay shape, the airlines are going to be in okay shape. We've got a couple of different stories there. Airlines, American Airlines has been weak. Southwest has been very strong. Delta Airlines has been strong, and United Airlines has been strong. And then you go to the trucking sector where we have this massive, tightness and rising trucking rates per mile, et cetera, et cetera. So, I'm going to stay in those names. And it feels like, if we want to be patient, that we can get paid being long transports here, even though it's a little bit dangerous being long at the highs, just like it always is.
Yeah, and just want to note what's going on right now. NASDAQ has continued to trade a little bit lower. We're down almost 1% on the day, and it really is Apple, but more recently Amazon's under pressure, trading down about 3.5%. We're just above 1,900. I'm not sure if there's some news on Amazon, but that's definitely pressuring the NASDAQ right now.
I tell you, if you're watching Amazon, you should listen to Jeff Bezos at the Economic Club of Washington, D.C. He did a pretty good interview, and he came off really a lot more tolerable than I would have thought, and he gave a really, really, really considerate talk with those guys. So if you're watching the stock, it's probably worth checking out that video.
Yeah, absolutely. Anything you're looking at for the next few days? I know it's a slow data week. We're kind of, I guess, focused on the next headlines from China, but anything ancillary in there that you're keeping a close eye on?
Yeah, we got to watch Turkey. We got to watch Turkey. They talked about putting together a sort of a bailout for some non-performing loans there. So I'm expecting that to sort of bubble up again. And I want to sell rallies in the European banks just for that reason. They're starting to pick their head up, but they aren't bouncing much. So I have a feeling that the next thing that we're going to see is another negative headline out of Turkey or another emerging market country like Brazil or Argentina, and we'll start that weakness all over again.
How can we get exposure to European banks? If I wanted to short European banks, how can I do that if I just have a U.S. retail account?
Yeah, I would pick a name. It's pretty. You can dig into the European Banking Index, which is SX7E. those are the Euro Stocks Banking Index on Bloomberg, and I kind of just I'm always in the habit of dissecting the membership to see what exactly have been the weakest stocks in there, and which are the stocks that are the biggest problems. So you can certainly go back to shorting Deutsche Bank, shorting Unicredit in Italy, shorting Banco Santander and Banco Bilbao Vizcaya in Spain, because those have clearly been the ones that bottom feed every time Turkey comes up with a negative headline. So if I look at it, if I'm going to pick a couple of names, I'm going to pick those 4 banks that are notoriously on their lows when we're talking about Turkish default.
Perfect. That's great information, and I'll take a look for some ETFs as well. I know Deutsche and Unicredit definitely do, but we can take a look to see if there's a U.S. sort of instrument on those other ones.
Yeah, there must be a Eurobank ETF of some sort. I'll see if I can find it for you, Mike.
Yeah. All right. Well, I'll update it in the chat as well. But thanks a lot, Tony. A lot of great information, and we'll probably be back later in the week, get an update from you. But thanks a lot, Tony. We'll talk to you soon.
Sounds great, Mike.
All right.